Good afternoon. My name is Nathan Russell, and today I'm going to be talking about using stochastic differential equations to model macroeconomic trends. Um, so right now we're just looking at the S&P 500. That's the only index that we're going to be using throughout this. But this could easily the code that I used here could be easily tweaked. Um, you could model individual stocks. You can model other indexes. You could model anything. Um, you could really model anything that could be graphed. Um, Anyways, so I'm using something called geometric Brownian motion here. So it's just Brownian motion is essentially it's unpredictable micro changes in any kind of system. So it's essentially a placeholder for randomness. It represents randomness. And there's a variable that we use here um, in the volatility that actually predicts what that uh, variable of randomness is going to be. You hear this in stocks all the time, in economics all the time, where they're talking about the implied volatility. You oftentimes hear that talking about options trading. We're not using something I'd like to clarify about this model. We're not using implied volatility over a short term. We are averaging the volatility over an entire time period and then using that volatility, projecting it into the future and getting our trend line through that. So it's not going to be quite as precise. The code could be written up pretty easily. I could write code up that actually predicts the volatility of the volatility, and then we could use that. That'd be a fun project. Um, I'm using Python throughout all of this, and all of the data that I'm getting, I'm pulling off of Yahoo Finance. Python thankfully has a built-in script that I can use to pull the data from Yahoo Finance and actually use all these variables. It has all these variables already downloaded onto a CSV file somewhere that I can just look at. So this is the equation that we're using fundamentally. It's modeling the stochastic growth, which in this case is the stock price. It's using the stochastic growth of the stock price using the derivative of the drift and the volatility, and then something called the Wiener process, which is the randomness. That's sort of the Brownian part. So this process right here is just simplistic enough that it gives us a single trend line, right? So when we look down here at these blue lines, that's what you're seeing in the blue lines. And then the red line is taken by averaging 20 of those essentially. So we're using for the for the drift, I mean we're using the logarithm of the returns across 252 days. The reason we're using 252 is because that's how many trading days there are in the year. So that gives us the average the average drift, across a single day, and that allows us to find down here st plus 1. So this is predicting what tomorrow is going to look like. So you take a data point and you say, okay, we're going to use the stock price on this day, times the exponential function that we're using, which is in relation to this one that we talked about up here before. We're going to incorporate our drift value, and we're going to incorporate our sigma, our volatility value, and we are going to predict a line based off of that. So you get 20 different of those blue lines that we talked about before, between the volatility values of 0 and 1, and that gives you the macroeconomic trends, and then we average all of those to get our standard trend line. So let's actually look at the code itself. Um, so this is the code itself, and every time you run it, you get a different value. So let's go ahead and run this again. There's quite a bit of code here. It's rather comprehensive. It's creating three different graphs. It's creating three different graphs here that are a we'll go ahead and just run this, and then I can explain it a little better here. So it's pulling these parameters off of Yahoo Finance. These are the parameters that we're getting directly from Yahoo Finance over a specific time period. So for this first one, it's taking all of this over the past 15 years. It's getting the average annual drift. It's getting the average volatility over the past 15 years, and then it is projecting all of those from the beginning. It's saying, okay, we're going to start from the beginning, and we're going to pretend we don't know anything about where this black line goes. The black line is the actual market. That's where the actual market went. It's saying we don't know anything about where the black line went, and we're going to project 20 different lines that say, okay, here's what we think might happen. A lot of these are really high, a lot of these are really low. There are 20 lines in there. You can count them if you don't believe me, but they're in there. Averages all of them, and it gets this red line. So this is more so just it's a test. It's a test for me. This says, how accurate is this model? How accurate is this really? You can look at the red line. You can say, okay, well, it's actually very accurate. This is exactly what I was hoping to see. It's a little bit high throughout a lot of these, but generally speaking, it almost perfectly represents. Like if you were to take each individual data point across the entire thing and average it, you're pretty well right on the money as far as where this is going. So even though we're not using volatility on a day-to-day basis, and we're just using volatility across the entire 15-year time period, we're still getting a very, very, very accurate trend line here. This gives us a good idea about macroeconomic trends and where the market's going to be going. So now down here, this is a 5-year price projection, and I'm using 5 years of historical data. So I'm going back from January of 2025 back to January of 2020, and then I'm projecting 5 years out of the future. And so this is about what you'd expect to see, right? This is pretty much exactly what you'd expect to see. Uh, a little disclaimer, because it's not taking in individual day volatility, and obviously my program doesn't factor in major economic changes, right? Like the introduction of tariffs or recessions or pandemics. There's just no way to incorporate that into a system like this. However, if you see a large downtick in this black line at the beginning, right, you will see that reflected in the future because it is using the volatility, the average volatility over the last X amount of time frame. We could really easily make a graph like this that just looks at the last 6 months and projects out into the next 6 months, and you can actually get a really solid line of where that is. You can also look. So down here, it spits out the fifth percentile and the 95th percentile. As far as like getting a good idea of where the market's going to go, these are pretty useless. But where it is very useful is that it tells you the benchmark, right? It says this is the boundary, right? We're going to say that realistically, the market is almost definitely not going to go below $550, and this is for the 5 year. So it's realistically not going to go below $550 for the next 5 years. At the end, it's not going to lose money. And it's almost definitely not going to go above 232 or $2,325. That's way up here at the top of the graph, that topmost green line. And so that kind of gives you your boundaries, right? You can say, okay, based off of the volatility that we've been seeing over the last 10 years, we know that the volatility over the next 2 years is going to be approximately between these two boundaries. Um, and you can actually get a good idea about what the state of the market is based off of how large those boundaries are. If I look at the last 6 months on a model like this, which I don't have a graph pulled up like that, but it would be easy enough to just put it in over here. If I pull the last 6 months of the market and I project the next 6 months forward into the future, and the boundaries on both of those are incredibly high and incredibly low, we can say, okay, our implied volatility is going to be pretty high. We know that we don't know for a fact there's going to be a lot of volatility, but we can say with a pretty strong confidence that there is going to be a lot of volatility. And then the green line in this one, this is not where the market's going, right? This is not a perfect predictor, and that could honestly be modeled by pretty much a straight line if we really wanted to, and it would tell us the same amount of data. That's telling us, okay, we're still seeing general growth. Where this would be really useful is that if you model this over the past 2 to 3 years, 4 years, 5 years, and then look into the future, if this green line or if this red line looking forwards starts to become level or even starts to go negative, then we can start to say, okay, something in the economy is causing the market trend to become negative. Something is causing the derivative of this function, right? The tangent, the direction of the market is no longer growing. Our GDP is no longer increasing, or even worst case scenario, it is decreasing. And through these stochastic differential equations, um, by it's just going to automatically pull the drift. And so if you've got a ridiculously low drift value, you're going to start to sniff out something's wrong, right? Something in the macroeconomic field is starting to go south. So you start to get some pretty normal values here. This is more so just like, um, honestly, just an ethos. Just lets you know how stable this model is, right? 98% over the next 5 years, that's pretty realistic. 24% over the next 2 years, that's a little high, but still pretty realistic. It's definitely not unrealistic based off the last couple years that we've seen, and factoring in some of the artificial intelligence and the tech growth that we've seen in the last couple years. I think that's a pretty realistic number. And so you can expect that over the next couple of years, if you buy a share today at $584, you know that it's probably going to be somewhere between $516 and $902 at the end of 2 years. From 2 years from now, that's what it's going to look like. And you're going to see an average return of about 24%. Could be a little higher, could be a little lower, but I would be willing to bet that it's going to be about perfect there. I'm going to do a 6 month. I'm going to run some code here where we do a 6 month history and a 6 month future prediction. And I'm going to see how closely that lines up to the actual future that plays out. This could be very useful. Most of the time, these kinds of graphs are used for predicting things like options traders use these oftentimes, or options issuers use these oftentimes to factor in their margin just to make sure that they're still making money. I'm going to put something like this up on my website. I'm going to make a real-time model of this so you can actually look real time and see exactly where the volatility is going. Because I want to be able to look at this graph and see how close this is, and at a moment's notice, you can see, okay, where's the economy going? What direction is this generally trending in? And it actually gives you a pretty significant amount of information. Usually, it's not anything that we don't already know, but it gives you a good idea of where the upper and lower boundaries are and where the median of the market is going. It gives you a good idea. It's a good health indication test. Um, so yeah, I'll put a link for this in my description that links to my website when I get that up and running, and you'll be able to see this real time. It's going to be a good market valuation. Until next time.